Hello. So I would like to go over problem number 7 on the Chapter 8 homework. Uh, I guess my concern is that it will, my Econ Lab will walk you through the problem, but I'm not quite sure if you're really going to understand why it's doing all the steps that it is. And so uh, if there's some confusion in that, I want you to have some resource. To make things quick, I'm just going to go through and add a little bit of commentary about what they're doing in each step. Situation, you have an $800,000 house in this version of the problem. Different people have different numbers. There's a flood every 50 years. You can build a seawall, which will decrease, which will require a larger flood, a once every 100-year flood, in order for the house to be destroyed and need to be replaced. So the question is, what is the annual premium without the seawall? Uh, Without the seawall, you have a flood every 50 years. So in any given year, the probability of having a flood is 1 in 50, or 2%. That's this 2% that you have right here. What In the background, this type of distribution, just a piece of trivia, is called a Poisson distribution. It's how we model events like this, but you don't need to know that. It's just kind of common sense on some level, that if it happens every 50 years, then its chance of happening at any given time is 1 in 50. So if one wants to talk about the expected payout from the insurance company to you, the expected payout is going to be 2%, the probability of having to make the payout times 800,000, which is the amount of the payout. The total payout would be, I can't do these numbers in my head. Oh, well, okay, there's Google. Well, let's see. I should 40,000, I think. No, that's obviously not right. Sorry, I really want to do this in one take. This could take forever, and I really need to rush. So, I guess that's 16K. Yes. Okay. 16,000. Luckily, they'll correct me if I get it wrong. The idea of saying why that would be the annual premium is that if that's the expected payout, that's how much the insurance company will expect to pay every year. If we assume that their other costs are fairly small, which if they operate at a large scale is close enough to true, we can use that as a good approximation for their total costs. If we say that in this entry there is free entry, then the marginal company must have zero profit. That's actually something you go over in 101 and in 201. How when there's free entry, as there is in a competitive market, firms must be making zero profits. So in order for there to be zero profits, their costs must equal their revenue, right? If your costs equal your revenue, and profit is revenue minus costs, then your profit is zero. So if the revenue is your premium and your costs are, as I've said here, 16,000, then your premium must be 16,000. That's the logic behind that. When we look at the possibility of having a seawall, the payout, so moving on, if we look at the possibility of having a seawall, the payout again will be $800,000, but it's much less likely to happen. It only happens 1 every 100 years. The probability of it happening is therefore 1%, and the expected payout is $8,000. Therefore, the premium must be $8,000 for them to have a zero profit condition and for them to both not go out of business and for there not to be further entry. Obviously, if they were making an economic profit, more firms would enter, and that would drive prices down until there was zero profit. Okay, great. Fantastic, Gus. Now we're going to move and we're going to say, rather than the insurance company paying 100% of the home value, let's suppose that it only pays 90% of the home value. 90% of 800,000 is 720,000. So we just say, okay, its expected costs and therefore its premium are going to be the $720,000 payout times the 2%, whatever that number is. I guess I have to type it in because I'm definitely not going to do that in my head. Hold on. Like my clicky keyboard. I do. it is 14. Oh, it is $14,400. Excellent. And so now we're going to go back from the perspective of the firm over to the perspective of you, and you're trying to consider, should I get this insurance or not? And what are you going to have to pay? Well, no matter what, you're going to have to pay this $14,400. That's the premium. But you might also have to pay for 10% of the house. 10% of the house is the value of the house. The house is going to need to be replaced, minus what you get from the insurance company. That'll be $80,000. Of course, you're only going to have to pay that $80,000 2% of the time, i.e. only when there is a flood. Again, we're talking about without a seawall, so it's a 2% chance of a flood. 98% of the time, you won't have to pay anything at all. Your total expected payment will be whatever that is, which is $16,000. And now we're going to go, again, staying at 90% of the home value. Feel free to press pause if you want to read there. But again, the insurance only covers 90%, i.e. it only covers $720,000. There's again a but now you have the seawall, so there's a 1% probability of destruction, and therefore you have an expected damage of $7,200. We're repeating this thing up here, but now with a seawall, you have to pay the $7,200 premium. In addition, there's also a 1% chance of destruction of your house and a 99% chance of no damage. So here, your I'm just going to, so here, if you plug those numbers in to your calculator, you will get $8,000. I didn't plug it into my calculator because I kind of knew the next step. The deal here, if you look at these, is that whether you have a 100% insurance policy or a 90% insurance policy, your total cost will always be $8,000. If you, let's see, if you build the seawall, it will always be $8,000. If you don't build the seawall, whether you have a 100% insurance policy here, it'll be $16,000, or if you have a 90% insurance policy, it'll be $16,000. So, whether you have the seawall or not, you're going to have the same expected costs. So from your perspective, there's no difference. But let's bring a little bit of economics in. Suppose, because this is a core issue whenever you're talking about insurance, whenever you insure someone, they don't pay the costs of a bad event happening. So if you have car insurance, you don't pay the costs of having your car damaged. If you have health insurance, you don't pay the costs, or at least not all the costs, of having your body damaged. And therefore, maybe you won't take as much care of it. Maybe you'll eat a little bit more ice cream and smoke more cigarettes if you know that, the healthcare costs won't bankrupt your family. Some people think that's a big issue, and we actually have a solution for it. In this situation, if you share some of the cost, if instead of having 100% insurance, you have 90% insurance, then the person who is insured, the homeowner, has an incentive to build the seawall. So you can imagine here, in health insurance, you don't know whether they smoke, The health insurer doesn't know whether they smoke, doesn't have a good way of measuring that. You don't know whether the guy's eating ice cream and taking care of his body. You don't know if he's exercising. So you share a little bit of the costs of the bad event with your customer. And then, since the customer might have to pay some of the medical costs, might have to pay some of the home replacement costs, they have a strong incentive to build the seawall. Um, that's just showing one way that we can beat moral hazard. If you want, you can come up after class and I'll show you how to calculate how strong the person's incentive is to build the seawall if we assume that. So we can go over that. Again, I just want to emphasize that this is a case of asymmetric information. It only matters if the firm can't observe the seawall. In general, it's better to have 100% insurance because people like insurance. It makes people happy. You don't want all of a sudden out of nowhere having to pay $80,000. That's why we buy insurance, because insurance is very, very valuable. But they may require some form of copay to prevent this moral hazard. So anyway, that's insurance. Hope it helped. If you have any questions, please ask.